Good afternoon, everyone. Welcome to today's Foundation Fridays webinar series from Foundation Mortgage. My name is Carl Holman. I'm the Director of Marketing here at Foundation. And today we're going to be talking at length about turning challenges into closings and non-QM. So we're going to give this a couple of minutes for people to come in before we get fully started, but I just wanted to do a quick welcome. And we'll do some housekeeping stuff before we get into all of that. So we'll just let people start to come in. Give it just give it just a little bit more. Okay, let's kind of get started, gentlemen. All right. Again, my name's Carl Holman. I'm the Director of Marketing here at Foundation. For those of you who may not be familiar with us, we are an exclusive wholesale non-QM lender. We lend across most of the United States. We have been around for a little over 20 years. We pivoted a couple years ago to be exclusively non-QM and wholesale. Before that, we were doing some retail, and we also do some non-delegated correspondent lending. We are based out of Miami, Florida, and we specialize with non-QM and really doing common sense lending, taking a look at every loan on a case by case basis and making sure we do the best for your borrowers. Like I said, we are licensed pretty much across most of the United States. We've got a few that are still pending, big on the East Coast and West Coast and down the middle. So we're pretty much where anybody needs to be. I'll introduce our speakers today. We have Sam Bajelic. He is our Senior Vice President of National Sales. And then we have the Inda brothers, Alex and Joseph. They are both senior account executives here and amongst our top producers. So we've got three highly knowledgeable people here who will walk you through a couple of our products today. So I'll just do the quick welcome and some housekeeping before we get into the meat. So we have disabled the cameras and chats, so we get a clean recording. You will get a recording of this presentation after about 24 hours. There'll be an automated email and it'll be attached to it. Feel free to ask questions throughout the webinar. Just use the Q&A panel. If you don't see that panel, it's usually under the little three dots at the bottom, or you can use the chat, but we'll get to your questions towards the end. We'll run through the main content, give you some updates, and then we'll go from there. And then there will be a very brief, like 5-6 question survey at the end when you go to log out. Let us know how we did and any topics you want to cover from there. With that, I will turn the microphone over to Sam Bajelic to cover the agenda, and we will go from there. Have a good go, guys.
Thanks, Carl. Appreciate it. Thanks everyone for joining. I appreciate your time. I know it's tough to make time out of your schedule. It's great that you're doing this to help yourself get educated and learn more about different ways that you can close loans, especially on a Friday, right? So the non-QM solutions we're going to cover today, we're going to go high level and then a little bit of deep dive and get granular on bank statement loans. Then we'll talk about debt service coverage ratio loans, or some people call them DSCR, right? These are going to be investment properties. And then we'll touch on closed end seconds, right? These are going to be fixed rate closed end seconds that are in the non QM space. Then we'll hit some recent updates of what's going on here at Foundation. And we'll talk about some resources that we've created for you on how you can enrich yourself, how you can go out and get more loans. And that'll be our marketing and training resources that we'll go over. And we should have some time, I think, at the end, Carl, to do some live Q&A. So let's get started with I think bank statements would be great. Oh, as far as the volume here, so so non QM right now, it's been the demand for it's higher than it's ever been. Right, there's more demand than there is supply. We've seen the RMBS securitizations higher than ever, the placements in the insurance companies higher than ever. Demand is very strong, and we're looking to educate more loan officers so they can create more loans, and we can get those loans sold and keep filling the void that's out there. All right, bank statement loans. Let's pause right here real quick. So what I want to get across is, so some of this is going to be very elementary because I know some of you are very new to non-QM, and some of you are probably super users in non-QM, and we'll get more nitty gritty and granular towards the end. So just in bank statement loans in general, these are going to be for typically self-employed individuals, so people that make a lot of money, but they don't show a lot of money on their taxes for whatever reason. They could have a good accountant that takes advantage of the tax laws. They could have multiple companies and layered companies that just makes their tax returns not advantageous to go on a full doc loan. These could be 1099 workers, where people have different jobs where they do consulting. It could be people that are in gig economy, right? They have different things that they're doing self-employed, or just in general, someone who just can't use the tax returns to qualify. We'll look at the cash flow from their bank statements to provide income and satisfy the ATR. So real quick, I think we'll go into some details and we'll let the Inda brothers, the tag team non-QM, go after it there. Go ahead, guys.
Okay, yeah. So bank statement loan, one of the highlights, and we've done a couple loans up to 4 million plus. The very attractive high loan amounts are out there for us on our portfolio product line. The next bullet, LTV is up to 90%. We're doing a bunch of 90 LTV loans. It's great for first-time home buyers. There's not an overlay for first-time home buyer and 90 LTV. There's not a payment shock overlay as well. So we do 90 LTV up to 2 million if the FICO's there. It covers a wide base too. So our minimum FICO is 620, and then the LTVs will stagger based off of the borrower's FICO score. We could do purchase, cash out rate and terms, and any occupancy type. We offer 12 and 24-month bank statement options. The borrower needs to have a minimum of 25% to be considered self-employed. And then from there, whether they do personal bank statements or business, we'll cash flow each one of those. One of the methods to underwrite their income is by using an account expense ratio letter, which we'll go into a little bit later. The minimum is 10% there. And then for the credit bucket, I mentioned we go down to 620. We also have options for credit events 1 year out of BK 13 or 7. And just you're going to get tiered down based off of LTV, but we do accept recent credit events. We offer to any citizenship type, U.S., permanent resident, alien, non-permanents, and then we have a separate I-10 program that also offers bank statement loans. You could invest in a individual trust. If you're an investment, you could invest in your LLC, corporation, and business purpose loans also are in this bank statement category for the borrower to invest in their LLC. We allow up to 55% on DTI for the primary, and we allow for some credit mortgage lates in the last 12 months. Gift funds are allowed. We'll allow you 100% gift. We just need you to have your own reserves in their account. So they could do 100% gift for down payment and closing costs, but they have to have their own funds for reserves. All right, so on the nitty gritty side here, option one for how we calculate bank statements, and this is probably the main important part of any bank statement loan, is based off of what the borrower does for work, whether they're selling a product or they're offering a service. And then we break that grid out even further on how many employees they have. That's how we get to the expense factor that we're going to use when we're calculating the bank statements that the borrower provides us. So let's say they're a loan originator with no employees. We're going to use 20% because that's service, no employees. Now, if they own a restaurant and they have 10 employees, that's going to be a product business at the bottom right, greater than 5 employees, using an 80% expense factor. So it's crucial when we're getting the bank statements that we really understand how the borrower makes their money, how many employees they have, and then we could take a look at their deposits, use the appropriate expense factor in this option, and then that's our monthly income. Option two is my personal favorite. It's an expense ratio letter. And this is a sample letter that we give out to our broker partners in case they need one. And it's a fillable one that you could send to the borrower's CPA or their licensed tax preparer. And this will give us the expense factor that we will be using for the bank statements. The minimum, as I mentioned, is 10%, but this will guide us down the path for the income. And why I like this letter a lot too is it also confirms self-employment, and it confirms ownership percentage, it confirms active and in good standing, and then the expense factor, which is key to actually understanding what the income is. So what makes this different? Non-sufficient funds is a very common topic. We don't have a guideline overlay for the amount that you need to have. Some places have 3, 6, 9. We don't have a number, which gives us a lot of flexibility, but we will look at what the story is. Is it consistent? Was it all front loaded, 9 months ago, and the borrower provided an LOE that was very specific to that incident? Or is it happening like, 3 each month? And what's the reason why behind that? So we're going to look at it very specific to that loan. It's just nice that we don't have a, hey, you're 3 and out, right? So it gives you an option to overcome any condition that could be a potential deal breaker at another place. We do, like I said, we do the full income review ahead of time, guessing what you see is what you get. And it tells a better story of what the borrower earns versus providing, their tax returns. Because as we all know, a lot of self-employed borrowers truly make a little bit more than what they might report on their tax returns. For sourcing large deposits, we call out anything that's over 100% of your gross revenue. So it's not going to be the ticky tacky, couple $1,000s here and there. But we will ask for general large deposits, and then provide sourcing. What could be an invoice. It could be a cancel check. One of those two things usually works for that. Okay, here's an example of a bank statement loan that we wanted to highlight. It's a $3 million loan, cash out in Montana. It was 20.3 acres, and it was rural. So we're hitting a lot of different buckets here. We're hitting rural, hitting 20 acres. Out of the cash out amount, I think the borrower netted about 1.7 million. So it was quite a bit of cash in hand as well, which is a great niche for us. And the main part of it is just making sure the bank statements were aligned and we were cash flowing appropriately.
All right, I think I'll take this one if you don't mind. So one thing the mortgage business does not lack is acronyms, right? And for those of you that are new to non-QM, you're going to hear a lot of DSCR. You're going to hear this acronym a lot. We've kind of spelled it out there, and I mentioned it earlier. It's debt service coverage ratio, right? So these loans are going to be for investment properties only. We're going to take the actual income for the loan is going to be what the rent is. So the rent from the property is going to be the income for the loan, right? And we'll get into a calculation in just a minute. So why are these loans popular, right? I think the main reason is if you go back, let's say, I guess it's 3 or 4, maybe 5 years now, when the GSEs put in the large LLPAs in, Fannie and Freddie put the large loan level price adjustments in on non-owner occupied properties. I think it was 300 or 400 basis points. They kind of said, hey, we don't want to finance these properties anymore. So what happens when there's a void in the marketplace? Well, typically that gets filled by private capital. And that's where these loans, they've come along. I mean, they were there before that, but they really become in play, I think, when Fannie and Freddie kind of stepped out of the space. So these loans, what's an advantage of these, again, you don't need personal tax returns. These are called business purpose loans. You'll hear that terminology out there. You can actually close these loans in states where you're not licensed, certain states, and we'll get into that in a little bit. And the majority of them close in an LLC, which the GSEs aren't going to let you close typically in an LLC. So let's get into the coverage ratio. Let's do the calculation. Carl, if you want to hit the slide. So again, what you're looking at is on the top there, you see the gross monthly rental income. That's going to be the income. That's the rent that you're going to see on the 1007 or on the actual lease. And then the total monthly housing expense is going to be, I call it the PITIA, right? That's going to be your principal, interest, taxes, insurance, and association fee, if applicable. So you're going to divide the rent by the housing expense, and ideally, you want to come up with a number over 1.0. There are programs that allow for negative cash flow at a much lower LTV and a higher credit score, and even some that get into a no ratio, which I think the Inda brothers will get into in a little bit. But again, that'll be much less leverage and much higher credit score there. And then you also have an example, I think. Oh yeah, here we're going to calculate it here. So we've got rent of $3,000. We've got a housing expense of $2,400. Again, that's going to be the PITIA, and that's going to give you a DSCR ratio of 1.25. So that's a great one, right? That's going to qualify very well. The next one's going to be, I think, the interest only example there, where we're going to qualify if interest only on this. We're not going to look at the PITIA. We'll just look at the interest only. And that one, in this case, the interest only payment's $3,000. The housing payment is $2,000. So again, you have a 1.5 ratio, and you're going to qualify. Pretty simple. Again, we kind of made it a little elementary for the folks that are out there and they're new in the business. We can get into a little bit more of the guidelines. I think, I don't know if Joseph, you want to run through that. We can hit a little of the other LTVs and all that if you want.
Yeah, absolutely. So a big component about this program, it does go to 3.5 million. We can do LTVs up to 85%, and then FICOs as low as a 620. Like Alexander mentioned, the bank statement program, it is staggered. So when you have a 620 FICO, you'll have a different max LTV than you would if you had like a 780, I would say. And then going into the terms that we offer. So we offer a 30-year or 40-year term, and then we can also add a 10-year IO option to those. So like Samuel mentioned, if we're tight on the DSCR, we just need a little bit more. We can always switch these to an interest only, and then that typically helps the debt's coverage ratio on that. So the qualification is based on the property cash flow. So typically, if you have the market rents on a purchase, we'll go off of that. Now, if it's a refinance, we'll take the leases over the market rents as long as we have 2 months proof of rent collection. We do have a low ratio, no ratio option available. So that's just when a borrower is buying a property, it's not quite cash flowing. We still have options for that. Our max LTV on that is 75%, which is still pretty aggressive. So we do have options for different kinds of properties in that case. No personal income or employment required. So when you guys fill out your 1003, when you guys submit a loan, you want to leave that blank. Since we're not qualifying with income, we don't care about their employment or how much they are currently making. This is offered on purchases, cash outs, or rated terms. A big product for us right now is short-term rental income. So we see a lot of those in Tennessee, Florida, Utah. Those are pretty common when you need to qualify based off of the short-term rents as opposed to the long-term rents. Now, we do need an appraiser to do a short-term rental survey, which we have like recommended AMCs that we can recommend over to you guys. But yes, that's like probably the better way to qualify if you're in a short-term area. And the great thing about this program is we do allow first-time home buyers. So if you have a borrower that have been renting and they've been trying to buy an investment property just because they want to expand their portfolio, we don't shy away from them. So as long as they have a DSCR 1.0 and a minimum of 6 months reserves, then we can land on first-time home buyers. Like Samuel mentioned, we can invest in a personal name, LLC, S Corp, C Corp, or in a revocable trust. We lend to quite a bit types of borrowers, so we can do U.S. citizens, permanent residents, non-perms, and foreign nationals. Foreign nationals are quite big in Florida, and we do them quite often. We have interest only available, like we mentioned before, and we do allow gift funds. So as long as the borrower has their own funds for reserves, then they can get a gift for the down payment and closing cost. We do allow up for 6% seller concessions, and we do property types such as warrantable, non-warrantable, co-ops, and condotels. Our condo team is immaculate in a sense to where if you have a condo that's not meeting Fannie Mae guidelines, go ahead and send us the paperwork on the condo, and we can have our condo team review the condo before it gets submitted. So that way we're not wasting time, and we can get you an answer typically within 72 hours on that. One of the biggest components on this DSCR program is that we can take the highest mid score of all borrowers. So for example, if you have a borrower with a 780 FICO and another borrower with a 680, then we can go ahead and take the 780 for qualifying, which typically on the DSCR loans, the FICO really drives the rate. Another component is we do allow vacant properties. So we a lot of times you get like fix and flips where a person hasn't had time to rent out a property due to a renovation. And so in that case, we would just go off the market rents to qualify. We do rural properties up to 20 acres. This is big. I mean, if in places like Montana, Utah, Colorado, there's a lot of properties, a lot of good properties out there that are not like within the 5 acres that other lenders typically go to. So us having like an expansive amount of acreage allowed, that really as Samuel mentioned earlier, we do allow, you don't have to be licensed in all of the states in order to originate a loan. For example, if you have your California license, but you want to originate a loan in Florida, then Florida allows you not to have a license in that state. And so you don't have to worry about that. So we do have a full list of states that you don't have to be licensed in. And then as you can see on the states on the map, we can send these out to you guys as well. So a recently funded one was we did a 38-acre property at 75 LTV. So this is just a pure example of common sense lending that we do here. We had compensating factors such as assets. We had a great FICO score, great housing history. And so all those three items really led us to make two exceptions on this file. So one is a 38 acres as our minimum is 20, and then the LTV exception to get a 75% on a rural property.
So far we've talked about bank statement loans, right? So those are typically first mortgages. Typically, those are more consumer mortgages, right? So typically first homes and second homes. We talked about debt service coverage ratio, right? DSCR. Those are typically, well, they're always investment properties, right? So there's, again, first mortgages. Now we're going to kind of pivot a little bit, and we're going to talk about second mortgages. So these can typically are done could be a purchase combo, or it could be a refinance combo, or it could be just a standalone second to pay off debt, just take cash out of the home. The big reason I think that this is more popular on the standalone is what's called the lock-in effect. That's your cue, Carl. There you go. Lock-in effect. So there's about roughly 64 million homes, I think, that have mortgages in the United States, and roughly 53% of them have a rate below 4%, right? So they're kind of locked into that, right? I have a 3% rate. I'm probably not going to refinance that rate, but I would go out and get a second mortgage if I needed more equity to remodel my house or do something else that I needed money for. So that kind of eliminates about 34 million people for the first mortgages, and that's why these second mortgages have become popular. And again, a closed-end second is going to be a loan that's fixed, right? It's not don't be confused with a home equity loan or home equity line, right? These are going to be fixed rate loans. We'll go into the actual periods. There's different amortization schedules that you can have, but this gives you as an originator a way that you can work with your borrowers. Typically, also we talked about self-employed individuals, gig economy workers, high net worth individuals that make a lot of money but can't show it on their tax returns. So we're going to talk like non-QM type of second mortgages and even DSCR second mortgages. So I think I'll turn that over. I'm not sure if Alexander or Joseph, one of you guys can run into that.
Yeah, I'll start us off here.
Okay, thanks.
The seconds, they do require a little bit higher FICO than the first. We require a 680 FICO. We can do up to 90 CLTV depending on the doc type. The max loan amount, you're seeing bold, we want to highlight 10 times over is we go up to 1 million for a closed-end second. If the CLTV fits, we offer 15-year, 20-year, 25, and 30-year fixed options. Most of the time, a 30-year fixed, but if the DTI aligns and you want a 15-year fixed, we can definitely do that. We cover full doc, bank statements, P&L only, 1099, written VOE, DSCR, and asset depletion. You could also use supplemental asset depletion with bank statement income combined to meet the ratios. We offer primary, second home, and investment options. We do allow for short-term rental, which is a niche for the second option. So if you have a short-term rents on a DSCR, for example, 12-month look back, and we'll use that for their market rents. And then mostly they're cash out seconds, but we do allow for the combo options there. And I wanted just to touch on, because we mentioned bank statement seconds, we do offer a bank statement calculator ahead of time, and we'll do the full review, as I mentioned earlier in the slides, of using the expense factor with the bank statements. It's online through our portal. It's a great tool. We do it on every loan before every submission, and that really gives us green light on the loan. And why I like seconds personally, just to throw this out there, is I've turned a lot of firsts into possible seconds. I've turned a lot of seconds that came in into, hey, let's do a cash out first, depending on the calculator. So it's just another tool to get more business in for the borrower that wants cash in hand. We do require 4-year seasoning, so that's a difference on this product with the added, second versus a first. Allowing 12 months on the second, we require 4-year. We go up to 50 DTI. The vesting needs to remain the same as it's currently on title on the property. So we're unable to change vesting if it's not currently how it sits. And then on a 1-unit single family with a loan amount of $250,000 or less, we do allow for a 2055 exterior appraisal to be done with an AVM in lieu of a full appraisal, which is nice. Gives a borrower an option if they wanted just to do a cheaper valuation model. They could always do the appraisal though if they would like. The AVM must have a high or medium confidence score. It's just a data report that pulls on the AVM. And then through our website, we have a series of calculators. One of them being a second lien calculator, which will you plug in your first lien information, you plug in the payment information, plug in the possible second lien information, and it's going to provide you with numbers that you could then talk to the borrower about on if this makes sense for their current situation. Should they do the second? Should we look at doing a new first? Or maybe we should look at another property because this property isn't quite fitting. But we do offer that on our website, which is a great tool.
Yeah, and to add on that too, if you're ever unsure of like what the best route to take is, just always reach out to your AE. We'll do the math for you as well, and kind of give you like a real life example like this one. So here's where it would come into play, where a borrower is kind of contemplating whether to do a brand new first mortgage or just to do a first and a second lien. Now, this example is going down our bank statement route on a $2 million value, and they're looking to get a new loan amount of $1.5 million. So the first option is doing the new first. So at a 1.5 loan amount and a 6.5% rate, which is today's rate on this specific scenario, the monthly P&I by itself is going to be $9,481. Now, if you do option 2 in this case, is if their first mortgage is at 3.5%, which typically, I mean, majority of our second business right now is this real life example right here. A lot of people are in that 4%, 4.5%, 3.5%. So in this case, they're at 3.5%. Their monthly P&I payments $5,837.58. Now, if they were to do a closed-end second for that $200,000, then we would be at an 8.25 rate with a monthly P&I of $1,502. And so this total combo payment is $7,339.58. So when comparing the two, I mean, this was just, I mean, clear cut on which one's the more advantageous for the borrower. And so doing the closed-end second is going to save the borrower around 2,100 per month, which is just a perfect example on why this would fit this particular borrower. This was a recently funded deal that we just funded back in December. So why this one is a really great example is we are allowed to combine income here at Foundation. So you can, what we did on this one is we combined W-2 income along with the borrower's assets for asset depletion. We did that and we were allowed to qualify and they were allowed to get a $1 million second on their $6 million home.
Running through these, Carl, or me?
You're covering these ones.
Sure. All right, no problem.
Yep.
So some recent changes here at Foundation. So we've got every month we usually have a special going on. So the special we have for February, we have an eighth improvement, all loans, $400,000 to $750,000. We've got a quarter improvement on pricing on all loans over $750,000. And then on the DSCR loans, which we covered earlier, you get a quarter improvement on all loans above $400,000. These loans must be locked by the end of February, and these loans must fund by the end of March. Next up, well, we actually mentioned it earlier. So again, $1 million closed-end second mortgages, the lock-in effect. We talked about that. Half the homeowners in the United States have a rate below 4% and probably don't want to refinance. This gives you the tool to go to them and offer a $1 million closed-end second. Again, with self-employed individuals, people can't go to the bank or a credit union and get a second mortgage because they don't have the tax returns. This provides you with a tool, with a loan program. You can go out and get more borrowers and close more loans. And something that changed recently too. Just last week, we allowed certain cannabis income to be to qualify. Again, these are going to be typically people that work for a CBD or cannabis dispensary. Obviously, it has to be licensed in the state. The state has to be legal. It doesn't include anybody that grows or manufactures the product or transports the product. You can contact your account executive for more information on this.
All right, great. Thanks, Sam. I'll take over for
Sure.
the training and
Okay.
marketing portion. At least I'll let you talk about the training a little more in depth in a few seconds here.
Sure.
So this is we've pride ourselves in trying to provide you guys with everything you need to hit the ground running, to get more borrowers, close more loans quickly. So one of the main things that we offer here are some customizable white label flyers. We've got flyers on every product that we offer, as well as transactional based things for things like short-term rental financing, multi-unit properties, that kind of thing. So they're fully compliant, legal, and they're available through our TPO portal. When you log in, there's a tab off to the right where you can download them and then fill in your contact information, your photo, and your logo, and then if you got state-specific disclaimers that are required in your territories, that you can put those in. So that's pretty critical. We do a ton of content on social media. It's not all product focused. There's a heavy broker education focus, both for you on the products that we do offer, how you can use them, how you can identify particular borrows, lots of tips and tricks, announcements about the webinars, the products, other events that we may be doing, and just a lot of common sense stuff that we want to make sure that we impart to our brokers. We're not here to just, push a product. We're here to help build a community of brokers that are knowledgeable and build out non-QM to be, everything that it can be. So we're active on LinkedIn and Facebook. I've got links here for you, so I would encourage you guys to follow us on a regular basis. We're publishing multiple times a week. And I did not include it here, but there's a link on the homepage for our website to join our mailing lists. We also do the same type of strategy when it comes to emails. And another big focus too is highlighting that, like the Endas have talked about, those specific unique deals that we do, either by exception or just that we really want to, let you guys know about. Hey, this is great, and we've done it. We've begun offering training. We brought on an entire training department to help both the broker shops and your loan officers who are in there so that you guys can know everything possible about the products that we offer. Sam, you want to go in a little more detail on that?
Yeah, sure. So this is my ninth year evangelizing non QM, right? So I started I broke off from the GSE Ginnie Mae business in 2017, and I specialized in non QM since then. And one thing when I first got into it in 2017 was I realized that the education and awareness needs to be the main driver to get this out there in the mainstream to get people doing these types of loans, right? And here we are in 2026, and I think the main thing that needs to be done is education and awareness to get these loans out in the mainstream so people can get out there and close more loans. So we're going to provide those resources to you. So if you're a broker owner and you get a new loan officer class in, use us as a resource. Let us do a virtual training with them. Let us go over all the income types that are out there in non-QM. If you have a referral source, you do some sort of meetings with realtor associations. Let us be your resource for how these realtors can sell more houses using non-QM loans with self-employed individuals. So that's a big part of it, right? The education and awareness. Then when it comes to loan submission, maybe you're a new broker that's just working with us and you're not sure how to use our system. Please leverage us. Schedule a time. Let our trainers walk you through it, hold your hand, and get that first loan in really easy, right? We'll help you do that along the way. And then anything else you need to do, right? So even if it's continuing education, if you have a monthly meeting with all of your LOs, let us participate with that. Let us come in. Let us teach your LOs how to do non-QM, how you as a loan officer can close more loans, as you as a broker owner can get more originations, more loans funded. Just use this as a resource. And we have this link down there that you can use. I believe we'll be sending this out, Carl, right? So everybody can have that.
Correct. Yeah, we'll be
Correct.
sending
Great.
out the link as well as the recording and a copy of the whole deck.
Awesome. Great. Yeah, that's kind of what I just want to hit the highlights there on training. Use us as your non-QM training department.
Okay.
Yeah, and so out on the road, it's great when you join these things virtually, right? But I kind of like the old days, right, where we're shaking hands and kissing babies out there in the place. So if you're in any of these markets, please, I'd love to meet you. I'll love to meet you. So we're going to be in February. We're in Austin, Texas, for the Texas Mortgage Roundup. You can use our code Foundation Free. It saves you about $100 or $150 for registering for the conference. Later in February, we're going to be up in Sacramento for the California Mortgage Expo. Same thing. For that, we have a foundation free code that will get you free into the conference, save you some money. And then we have the Broward County Annual Trade Show. That's going to be down in Fort Lauderdale at the newly remodeled Broward County Convention Center. That's going to be March 11th. I'll be speaking on a non-QM panel there. You can come listen to me talk if you really like this, you want to hear me talk some more. That's a great place to see it. Or if you love the Jersey Shore and you just want to get down to Atlantic City, hey, March 22nd through the 24th, me and Snooki will be down there hanging out with the New Jersey mortgage bankers at their annual conference. I'll be participating bright and early Monday morning on a non-QM panel. So these are all.
Okay, great. And we'll get to the Q&A in just a second. So as we talked about, broker education is a pretty important part of this. Not just all products all the time, but we're going to be doing a spring housing forecast with Dr. Salma Heap from Cotality, which used to be known as CoreLogic. They're one of the major data providers about the housing industry, and she's their expert specifically in mortgage. And then an old colleague and friend of Sam and I's, Rick Sharga. He is with the CJ Patrick Company. He is also, again, another real estate expert. Together, they are often referred to, or sorry, not referred to, quoted and included in lots of media stories about the current state of the market. So we're going to get lots of data, but it'll also be really focused on how you guys can use that data to kind of get ahead of your competitors and build out your pipeline when we look at where the market's going. So we're looking forward to that, and we're really happy to have two outstanding speakers like that with us. So we will get to the Q&A section. We did have a couple that came in Arian wants to know if you allow for a broker to be a borrower on DSCR. I think, Alex, is that one that you can take?
Yeah, so they can't originate their own loan. So another loan officer in the company can originate their loan for them. But yeah, we allow loans to brokers, just not you can't self-originate your loan.
Okay. And this question came in: can cash heavy businesses still qualify with bank statements?
Yeah, they can. What we're going to see on those bank statements, as long as they're depositing in their account, and typically if they deposit one like lump sum per month, then we typically want like some type of invoice. Or if they're depositing sporadically, we still want to see just some kind of invoice so we can prove that it is income. But yeah, we do allow cash businesses.
All right. Does that
Yeah, and
include for,
just
oh, does that include seasonal income? You know, that you got a lot of people that work seasonal jobs. Um,
Yeah, I mean that's one of the biggest things that here we don't really look too far into declining income. We do have declining income due to seasonalities, like you mentioned, but typically with a letter of explanation saying, "Hi, I run a gas station business and I live in Ohio, so 3 months out of the year it slows down quite a bit." So stuff like that, to where like we're just trying to find more makes sense lending there.
yeah, and if you fill out the narrative form, that's what's so huge about doing that ahead of time and getting this income done by our team ahead of time. Within 24 hours, we'll do the income for you. So that way, if you're worried about the income, or if you have questions on it, send it to us. Send us what they do for work, how they make their money, how they deposit. We'll send it, and we'll get a full underwriting review within 24 hours of, hey, this is what you see is what you get. And then from there we could say, okay, well, maybe a P&L only option is a little bit better, or maybe this income works, and now it's just figuring out the expense factor. But highly recommend using our bank statement calculator and getting that done ahead of time.
okay. Another question: can DSCR loans be used for 2 to 4 unit or 5 to 10 unit properties? So I guess multi-purpose or multi-unit properties.
Yeah, we go up to 10 units on our DSCR program. Meaning one of 4 units is our bread and butter. Our 5 to 10 unit program. Yeah, it's still, we allow first time investors. Well, the restriction to LTV. But yes, that we do to 1 to 10 units for that.
Let me see. One more. What documentation is required to verify existing first liens? Not sure if that's.
And we'll ask for the note and then property profile. And then in underwriting, we'll always ask for your payment history on most recent 12 months. So typically, the mortgage statement, the most recent mortgage statement is required because credit reports usually don't go up until that most recent month. And then we'll just pair up those three items and document the mortgage that's recorded.
Okay. We have one last question. Looks like it came in from somebody that might arrived a little late, but whether rural properties are eligible under DSCR, and I think we showed a couple of examples of that, but just if you want to highlight that again real quick.
Yeah, we do rural properties up to 20 acres. We can go higher on an exception, but we do not shy away from those rural properties, which is nice.
Okay. All right. That seems to be the last of the questions. I'll do a quick wrap up here again, and give anybody some last minute questions to sneak in here. So yeah, we're doing these webinars on a monthly basis. We've only planned out for the next couple weeks. We want to get more input from the brokers. So when you take the little closeout survey, there's a specific question about potential topics. So we would love to do more content that is directly coming from your inquiries rather than just us shoveling it to you thinking we know exactly what you want to hear. So we really do value that broker input. Let us know how we're doing in terms of whether these are too long, too short, or if we're being informative enough. So we just want to keep getting better at getting these webinars honed in and perfect for you guys, since this is a new endeavor for a few of us. Some of us have done these for a few years, so we just want to get there. Here's a question from Philippe. On the rural properties, can it be land only, or does it have to have a building?
Yeah, you have to have a dwelling for us. We don't do land loans, unfortunately.
Okay. All right. Thank you, guys. I think that.
And then a common question too that I get, so I'll kind of just ask and answer, I should say,
Ask your own
is
question.
yeah. So the typical question I get are business purpose loans only for DSCR? And my answer to you is our answer to you is no. So business purpose loans can be bank statements. You can qualify full doc. You can qualify asset depletion. So the list of states that you don't have to be licensed in, that still pertains to those doc types as well. So it's not solely DSCR.
So everything on the slide we showed with the map.
Yeah, exactly.
That one. All right. Cool. All right. Well, I think that is the wrap up. Like I said, we'll be sending out the recording within the next 24 hours, along with a copy of the deck. We'll include the contact information as well for each of our speakers, in case you want to get in touch with them, or if you are not an existing broker, we can follow up with you as well to get a broker package in, and you can start doing business with us as soon as we can. Yeah, so I think we're good, guys. I want to thank the Indos and Sam for helping us put this presentation together. And we hope that you all have a wonderful rest of the day and month, and we wish you great continued success. Have a great day.